What I find interesting about this is you see here they're blaming inflation on the pandemic and on the war in Ukraine. I mean, the inflation that we're seeing now, the price inflation, is really a product of the increase in the Fed's balance sheet. Greetings, land of Arcadia economics, and welcome to another bi-weekly episode of my podcast. I don't really have a name for it. I guess we could call it the Investment Research Dynamics podcast or the Mining Stock Journal podcast, whatever. But today I wanted to talk really briefly about the FOMC meeting and the subsequent policy statement, and also go into the gold-silver ratio just briefly. So as everyone knows, today was FOMC day, and of course it kicks off the almost monthly circus of everyone waiting for the policy decision to be released, and then for the clown show, also known as the Jay Powell presser, afterwards. So the market moves up and down leading up to the meeting, and then after the policy statement hits the tape, it's just the whole thing's a total joke. So as everyone's aware now, the FOMC issued a 50 basis point rate hike. I believe the target range now is 4.25 to 4.5, something like that. And it doesn't really matter. I mean, interest rates are still extremely negative, especially if you use a real inflation number. But what a lot of people don't do is they actually don't read the actual policy statement, and it takes less than 5 minutes if you read it slowly. And everyone seems to rely on the expert analysis. Well, the expert analysis is total BS. So I just wanted to point out a couple things in the policy statement here. As you can see, I wanted to highlight what I believe are the salient points. The market may try and squint in between the lines and look for any sign of a pivot. There is no sign of a pivot yet in there. The first salient point in the statement is inflation remains elevated, reflecting supply and demand imbalances related to the pandemic. Well, we'll get to addressing that in a second. The second salient point is the war, and they're talking about Russia's war in Ukraine, which is really the Russia-U.S. war being fought in Ukraine. The war and related events are contributing to upward pressure on inflation and are weighing on global economic activity. Well, maybe in some sectors it's weighing on global economic activity, but it certainly isn't for the defense industry. The defense industry is going gangbusters, and Congress just approved a record defense budget for 2023. So some people are benefiting mightily from this. What I find interesting about this is you see here they're blaming inflation on the pandemic and on the war in Ukraine. I'm going to come back to this statement in just a second, but wanted to show another interesting chart here. The inflation that we're seeing now, the price inflation, is really a product of the increase in the Fed's balance sheet. Now, that goes back to 2008. The Fed took the balance sheet up to around 4.5 trillion between 2008, and I think it stopped its QE program in 2015, maybe 2016, whatever, it doesn't matter. And you can see they started trying to reduce the balance sheet. And then during the pandemic period, and after that, the Fed took the balance sheet initially up to 7 trillion, and then ultimately up to close to 9 trillion. That's what's causing the inflation. The scapegoat is the supply demand imbalance from the pandemic. Well, that's a couple years behind us, and by most indicators, really the supply chain issues cleared up over a year ago. And now there's massive excess capacity shipping capacity globally, which tells you there's no such thing as a supply-demand imbalance in the global economy. And I mean, the war in Ukraine causing inflation, yeah, it caused the price of energy to go up. Certainly, the U.S. defense industries inflating the prices they're charging the U.S. taxpayer for all of the war equipment that's being sent over to Ukraine. So certainly there's that aspect of inflation, possibly some contribution to food inflation. However, this is your real culprit here. This is massive money printing. I don't care if they say, oh, well, it's backed by treasuries and mortgages. So what? This is liquidity. This money printing becomes bank reserves, and the bank reserves are then translated into money supply via the credit market mechanism. And really, through the stock market and through the inflation of assets such as housing. And that gets converted into money because a lot of people have taken out home equity lines and spent that money, vacations, cars, remodels, whatever. That's your source of inflation, not the supply demand imbalance from the pandemic, which was over 2 years ago, and maybe partially attributable to the war in Ukraine. So really, if they want to attack inflation, it's going to happen maybe somewhat by taking interest rates up to neutral, which means if you look at just the CPI inflation, it came in at 7.1% year over year earlier this week. So that suggests that the Fed funds rate should at least be 7%. And the Taylor rule would tell us it should be more like 10%. Now, arguably, really not arguably, inarguably, the real rate of inflation is much higher than 7%. So I know John Williams' shadow stats has it around 16%. So look, we're not even going to talk about whether or not the Fed would ever dream of taking the Fed funds rate up to a true neutral rate. So it's really taking the balance sheet back down. And supposedly quantitative tightening has happened. And I guess if you squint, you can see a slight reduction in the Fed balance sheet. And this slight reduction in the Fed balance sheet has caused a massive, well, I guess not, maybe massive is a little bit of an overstate, a considerable reduction in bank reserves and also in deposits. And that's where you actually take money out of the system, or remove money that's been printed. As you reduce the bank reserves, deposits go down, and somewhere down the road, I think the kind of rule of thumb I recall from my economics 300 level, whatever, in business school, is that it takes about 6 to 9 months for Fed policy, whether it's tightening or easing of monetary policy, to transmit into lower prices or a reduction in prices, which are really the evidence of inflation or deflation. Inflation and deflation refer to the money supply. And when the Fed prints money in excess of the marginal increase in wealth output, then you have more money chasing a lesser relative amount of goods, and that's inflation. It's really that simple. So at any rate, the markets ran up yesterday in anticipation that there was a lot of rumors going around that December would be the last interest rate hike. They'd take it down to 50 basis points, which they did, and that they would pause. And currently, well, at one point, the drop in the stock market in response to the policy decision and the subsequent Powell clown show, the stock market at one point had erased most of yesterday's gains, and now it's starting to rally back a bit. So perma bullishness is ever eternal until it gets completely stamped out. And I don't know if the Fed's going to completely stamp it out or not. That remains to be seen. Oh, one more point. Headlines scroll across from Powell's speech, and he's made it clear they're going to continue raising interest rates into 2023. So we'll just take the FOMC and the Fed and what they end up doing one meeting at a time. Now, I wanted to one more point about what's happened in the markets in response to today's decision. The precious metal sector is actually hanging in pretty well, and I think we're starting a major bull cycle in the precious metal sector, and I don't know if I've discussed that, my thinking on that in these podcasts recently. I've certainly been writing about it in my mining stock journal, in my market analysis section for my subscribers. But there's a lot of indicators, and one of them, for instance, is today. I mean, if you had told me that the stock market was going to react the way it did to the hike in the Fed funds rate, I would have said, yeah, they're going to hammer the hell out of gold and silver and the mining stocks. Well, guess what? The mining stocks are down a bit, but the Amex Gold Bug Index right now is down about the same amount as the S&P, and it looks like it's going to start going positive. So there's some resilience going on in the precious metal sector that, to me, is one of the indicators that we may be entering an extended sustainable bull cycle. I'm just looking here. The price of gold is bounced back completely after the customary smash that happens when the policy decision hits the tape after every meeting. Today, for instance, gold got smashed down. Looks like about 13 or 14 bucks right after the headline announcements, and now it's actually a couple bucks above where it was before the policy decision was released. And silver's over 24 now. So silver started to explode again, which takes me to the gold silver ratio. I thought about this. Someone on Twitter had posted a chart of the gold silver ratio and was, talked about how it hit an all-time high here in 2020 and came down, bounced, and now it looks like it's heading south again. So when I made this chart earlier, it was at 76. It's actually going to be a little bit lower now. The problem is he cut the chart off at 2018. And to really see what's going on with the gold silver ratio, you got to go over a much longer time horizon. And I didn't have time to do it, but there's charts that can actually show you the gold silver ratio going back to, I think, the year 1200 or something. And it's kind of interesting to get into the history of the gold silver ratio, maybe for another podcast. So I decided, you know what, let's take a look at the gold silver ratio. And this is another one of the reasons why I think we are heading into an extended bull cycle in the precious metal sector. Now, when I say extended, there was what I would call a bull cycle from, say, 2001 to the spring of 2008. And then we had a massive sell-off in the sector. And then another cycle that started from 2008 to 2011. Or you could actually say there was a long bull cycle. And if you cut out the smash in 2008, and there was actually a smash in 2006, you cut those out, and you really had a 10-year bull cycle from 2001 to 2011. And then you had about a 4.5-year bear market cycle that went from late 2011 to the end of 2015. Well, I guess really since August of 2020, it's been in a little bit of a downtrend. And this, you can see the gold silver ratio was up here, and that's usually an indication that the market's going to go sideways. Precious metal sector is going to go sideways or head lower, is when you start to see these big spikes up like this. Well, now we had a nice spike down, and I think, and then a bounce, and I think we're at a point now where this thing's ready to go a lot lower. At some point, the Fed is going to be forced to pivot and possibly start printing money again, because as liquidity gets withdrawn from the credit markets and the banking system, it's going to push the banks into a tenuous financial situation. We're already seeing that with Credit Suisse. I mean, supposedly they just got a $4 billion recap done, but prior to that, Credit Suisse was ready to hit the wall. And there's some other banks out there that are also teetering and probably not that stable. And that would include some of the big US banks. So I drew this line in here to kind of show that right now the gold silver ratio, if you look at it going back to 1990, and my stock charts subscription only lets me go back to 1990 with this data. So that's why I started in 1990. But you can see that for roughly 75% of the time since 1990, the gold silver ratio has been below where it is right now, which is 76. And so I just think from a probability standpoint, it's time for a reversion toward the mean, which would actually probably get you down here to the 50 level. So that would just be the mean level going back to 1990. And I actually think, and if I'm right about being in an extended bull cycle, I think that we could see the gold silver ratio go all the way back down to 30, where it was in early 2011. And actually, I think there's a chance we'll go below that this time. And the reason I say that is because all of the fundamental variables that caused gold and silver in the precious metals sector to explode back then are back again, only they're much greater in intensity. And so that's why I think at some point we're going to get a rally in the sector that's going to be much greater in intensity. So, and there's plenty of other fundamental factors that you can throw in there. And of course, not the least of which, if I circle back to why I think the Fed's going to pivot, at some point, the Fed's either going to have to let the system burn to the ground or it's going to have to start printing money again. So, in my opinion, right now, while gold and silver are both extremely undervalued relative to all other investable assets, I think silver is by far the best value investment and the cheapest asset that you can put your money into right now out of any of the assets out there. At least the assets that are liquid and that most people would have access to investing in. There's probably some weird commodities that may be better value than silver, but I don't know what they are, and I wouldn't know how to invest in them. I know how to invest in silver. It's really easy. I bought some silver pandas earlier this week, and they should be coming tomorrow, and I'm looking forward to it. So at any rate, I don't know. I'll have to talk to Chris. I don't know if I'll do a podcast in 2 weeks on the 28th, or maybe Chris and I will do one together. But either way, I want to wish everyone happy holidays, whether you celebrate Hanukkah or Christmas, and try to have as much fun and don't let the stresses of what you see on your computer screens and in the world around you get in the way of having an enjoyable time, hopefully with your family. And I suppose one way or another, I'll see everyone in 2 weeks. And until then, have a good time.
Well, thank you, Dave, as always, for this week's video. Great to get your take on the Fed's latest announcement, where again, they raised 50 basis points at this meeting, as well as some updates on the gold and silver markets. So hope you found that helpful at home. And would also like to thank Silver Viper Minerals for bringing us today's video. Saw Steve Cope of Silver Viper on the show a couple of weeks ago, and he was talking about how they recently announced a deal to acquire Kranzler Resources, which would potentially give them a package of new resources should the deal go through as planned. The Nora asset being one of the key centerpieces to that, an asset that Silver Viper had already done work on and has familiarity with, as well as a package of other assets that come as part of Kranzler, which gives Silver Viper a few options of what to do with that. And also wanted to mention that as part of the deal, Silver Viper was required to do a private placement financing, which is now undergoing and underway. And if you'd like to find out more about that, you can go to silverviperminerals.com, as that financing includes a share at 20 cents and a half warrant exercisable at 30 cents for a period of 20 months following the closing of the deal. So congratulations to Silver Viper on their recent announcement, as well as the private placement. And to find out a little bit more about the details of that, I did have Steve Cope back on the show to talk about that as well. And that video is coming your way right here.